Hey guys, welcome back. I'm Chris. This is Midlife Crisis Podcast. In today's show, we're going to kind of be continuing on our Back to Basics series. We're going to be talking today about investing. Again, this is a back to basics, so we're not going to get too in depth, but we're going to cover a lot of stuff in a short time here on the show today. So, I will have notes up on the screen, so you'll be able to go back, and if there's something you don't understand, you can go back and re-listen to it and look at the notes, and hopefully it's pretty easy to follow along with. I'll get right into it today. First thing we're going to talk about is conventional savings. Now, somebody might look at investing and say conventional savings isn't a way of investing, but again, on a basic level, when we're looking at investing, savings does pay you a return, so it still does fit into that savings category and that investing category. So that's why we're starting with savings. We're actually going to look at some of the low yield options, then we're going to actually look into some of the higher yield options, and just kind of give you a good round look at what investing is all about. So one of the great things about conventional savings is it's your safest option. It's easily accessible. You can, transfer money back and forth from your checking account. It's there in case of an emergency, which is also a drawback as well, because one of the things that we do as a society is we consider an emergency, we need a new TV. Well, that's really not an emergency. So that's one of the disadvantages of having the money so easily accessible, is you can kind of justify spending it on what we consider an emergency. So the great thing about savings accounts, though, is they are federally insured up to $250,000. So your money is safe. If something ever happens to it, you are going to get that money back. Unfortunately, the interest rate on most savings accounts is going to be very, very low. 0.09%, at your local bank is usually what they're going to pay. You can get into different kinds of savings accounts, like a high yield savings account or a money market account, which are going to pay you 1 to 2%, which is relatively low. But if you have enough money that you're not too worried about it, or if you're averse to risk or something like that, and you really don't want to risk having your money disappear on you, a high yield savings account or a money market account is a really good idea. So the other thing to remember is with savings accounts, you can only do 6 transactions monthly, 6 withdrawals. So if you do actually need that money accessible, you can keep it in your checking account, or else you can look at some different options. Next one that we are going to talk about is CDs. Now, for those who don't know what a CD is, it's a certificate of deposit. Now, CDs are again a low yield product, but basically you deposit a lump sum into an account, and it's usually has to be in there for a set amount of time. So you might put $10,000 into a CD for 12 months. So if you remove it from there before the 12 months is up, there'll be penalties, you'll get less return, but to actually get the full return out of it, you have to leave that investment in there for 12 months. Nice thing about CDs, you can take your money out, so they are readily available like a savings account. They are federally insured, and they're safe and predictable. So for a first-time investor, or someone that's retired and just wants to have their money easily accessible, and they know they're not going to need it for a set amount of time, 6 months to a year, 18 months, this is a good option. And you can stagger out your CDs as well, so that they mature at different dates. So every 6 months, you're going to have a CD mature. So they are a good option in that way, and again, safe and predictable. Next thing we're going to talk about is bonds. So bonds are debt securities. So there's going to be different types of bonds, and they're going to be, your risk is going to be dependent on what type that is. You're going to have government and corporate bonds. Government bonds are generally pretty stable. You're going to get your money back out of them. Corporate bonds are a little bit more risky because of the risk that business might go out of, or that corporation might go out of business. So remember, they are debt securities. So basically, this company is borrowing money from you and saying, I'm going to pay you back your money plus interest at this date. So So basically, the fact that they are borrowing money that they need to keep in business or to expand in business actually increases your risk quite a bit. When we're talking about government bonds, those are generally going to be bonds. So if we go to war, they're going to issue a war bond. I'm sure everyone out there's heard of war bonds. So, the government, unfortunately, can print money at any time. So, you're pretty much guaranteed to get your money back from a government bond. So, a couple things to consider when you're looking at bonds and whether or not you want to invest your money into those. A lot of bonds too, they are a regular source of income. So a lot of bonds will have stipulations in them for payments, like say quarterly payments. They call those coupon payments. So every 3 months you're going to get a certain amount back, and then you're going to get a profit at the end of maturity. So those are definitely things that you want to check into. They are an advantage to people who want a little bit of money coming in, and then maybe a little bit of a lump sum at the end. So think about that. Also remember that there is a risk of default, so you want to make sure that you either accept that risk or that you mitigate your risk by doing your research. Find out if it's a corporation, what they are going to do with the money, what the analysts think. This is a place where a financial advisor would come into play to help you, because they've done all the research for you. So this would be a good place to, talk to a financial advisor if you want to get into a corporate bond. Next kind of investment we're going to talk about is mutual funds. Okay, mutual funds are probably one of the best and most stable out there because they're a mixture of securities. So you're going to have a lot of times, depending on the type of fund, you're going to have stocks, you're going to have some sort of bonds in there. You're going to have a whole bunch of different things, electronically traded funds, index funds. There's a whole bunch of different things that they are going to put into that. A lot of those mutual funds are actually based on specific investment goals. So you'll see, like if you go on to one of the big investment firm websites, you can actually look at their mutual funds and see what is actually in there, what they put together to make that into a mutual fund. So if you want long-term slow steady growth, you're going to be looking for for a mutual fund that's mostly bonds, CDs, things like that, maybe with just a small portion of stocks in there. That way you're not going to see the fluctuations. If you're young, or if you don't have an adversity to risk, you might want to look at an aggressive fund, something that has a lot of stocks in there, maybe things like oil and gas and international funds, things like that. Those are going to have a lot more risk but a lot more return, and you're going to see a lot more fluctuation in those kind of accounts as well. You're going to see ups and downs, and for some people that bothers them. Some people want to see a slow steady growth, and that's where a slow growth mutual fund, something steady, is going to be more for you. Moderate growth, that's a good mixture of both of them. They have all the different levels. They have, you just have to, do your research, look. A lot of mutual funds too, when you click on the funds, you can actually look to see what their average rate of return is over, say, a 5-year, or say a 1-year, 5-year, 10-year term. So, that can help you make a decision as well, especially if you're willing to just put your money in there and wait and not, worry about trading out when you hit the dips or when you hit the peaks, things like that. If you're just willing to leave it in there, it's good to take a look and see what their average rate of return is. So again, I kind of mentioned, I kind of went through these equity funds, fixed income, balanced would be the one that is going to be your moderate growth. So I did skip over one of the advantages, and that's that when you invest in mutual funds, you're investing with another pool of investors. So, say a stock like Amazon that's, up around the $2,000 range, most people aren't going to have the capital to be able to invest enough in a fund or stock like Amazon to make a real difference in their investment account. So by investing in a mutual fund that says, or that, includes a company like Amazon, you are investing with a whole bunch of different people, pooling your money together and owning a fractional share of everything in that mutual fund. So that's one of the advantages. The other advantage is the fees are relatively low. 1 to 3% is generally what the fund manager will charge. And when you put that on a bigger scale of what's actually in that, it's pretty reasonable. And most of the time, you're not going to see an actual debit. You're going to just, they're going to take that into account as they're showing the growth and the actual rate of return on your mutual fund. The next thing we're going to move on to is 401ks. So 401ks are a retirement investment account. They're offered by most employers nowadays, which is good. You can actually have the money directly taken out of your paycheck a lot of the time. You can set your contribution limit. And then great thing about 401k is it's tax deferred. So for people that might be in the middle to upper income level, it's a great way to lower your taxable income. Like if you need to stay below a certain set income, this is a neat way to, keep your income lower because it is taken out pre-tax. A lot of employers nowadays are doing employer matching. So, whether or not it's 2, 4, 6% or something in between, whatever money you put in, they are going to put in as well. So it's a great program to take advantage of, and it helps your investment grow a lot quicker. A lot of employers will have a vesting period as well, something to check into as you're doing your calculations, whether it's 1, 3, 5 years. I've seen a whole bunch of different ones. Actually, the company I work for does not have a vesting period, so I was vested immediately as soon as I put money in. So that's great for me because that money that they put in is mine to keep, whether or not I stay with the company or not. So something to check into. When you put money into a 401k, though, the one disadvantage is if you want to withdraw that money, you're going to have to pay taxes on it, and you're probably going to have to pay penalties on it. So, keep that in mind as you're putting money in. You want to make sure that whatever money you put in, you can afford to take out. Right now, a lot of companies are allowing withdrawals because of this COVID-19. A lot of people out of work, so a lot of people are actually falling back on some of that money they put in their 401k to survive right now. A lot of companies are waiving the penalties. I'm sure the government's probably going to do something. We'll see what happens in next year's taxes. They might have some kind of tax relief or tax credit to kind of offset the cost of the additional taxes from having to withdraw from your 401k. It is taxable income at retirement. So as you are withdrawing your money at retirement, you're going to have to pay taxes on that. So that's another thing to keep in mind. And there's a whole bunch of IRS withdrawal guidelines that are going to go with it. Like you will have to start withdrawing money out of there at the age of 70 and a half. Depending on how much money you have in there, there's a percentage, there's a calculation. I won't get into that today. The other kind of retirement fund is called a Roth IRA. Now, the big difference between the 401k and the Roth IRA is Roth IRA money is money that's taken post-tax. So you've already paid taxes on it. So, this is actually going to impact you a little bit more. But the great advantage to that is that your profits on that, what the growth on that is going to be tax-free. It's going to grow tax-free. And you can withdraw out of that without paying taxes on it because the government already looked at that and said, hey, you already paid taxes on that. We're not going to require you to tax it again. So that's an advantage. The limits on it are quite a bit lower. I think for 2020 on the regular 401k, you're allowed to put into about 19,500. I think it's about 6,500 for the Roth IRA is what you're allowed to put into it, up to a maximum of 26,000. For couples, it's going to be more. You can look up those numbers for yourself, but it's a great way to save some additional money. And again, that money is going to grow tax free. So if you start a Roth IRA when you're young and you apply the rule of 72 to it, that $10,000 that you invested at 20 years old, by the time you're 64, it's gonna double, or what is that, 44 years, so just over 7 times it's going to double. So that $10,000 is going to be 20,000, 40,000, 80,000, 160, 320, 640,000. So 630,000 of that is going to grow tax free. So when you go to withdraw that at retirement, it's going to be tax free money that you can take out. So a lot of things to think about there. There's a lot of different investment types, and I know I kind of went through them fast, but I just wanted to kind of give you the basics on each, just to give you some more information. And again, you can go back through the video and review the notes and review some of the talking points I made, and if there's something that you didn't quite understand, go ahead and make a comment down below if you'd like me to cover something more in depth. We're going to kind of continue this series as we go on, and we're going to kind of keep talking about some basic financial stuff. We'll get into maybe some credit card information in the next episode, talking about interest rates and paying off debt, things like that. Haven't quite gotten an outline done yet, but if there's something else that you'd like to see, go ahead and see below. And just wanted to give a shout out to Ginny Diana. Go check out her channel. A lot of great information on going to college, being a student, being a mother, being a wife, all that kind of stuff. She made a comment on the last video that she would like to see some more of these basic videos. So I just really thank you for that comment, and I thank you for interacting with the channel, and we'll keep going on this. Hope you guys enjoyed the content today. We'll see you next time. Make sure, if you haven't subscribed yet, to hit that subscription button, hit that like button, and hit that bell icon so you're notified when new videos are uploaded. Thanks, and see you next time.